The Fed raised its key rate by 25 basis points, and it left the door open not just to 2 more hikes this year, but 3. That's a bit controversial. And what surprised people is the Fed speeded up the pace of rate hikes for the next 2 years. Are you on board with this decision?
Well, first of all, thanks for having me, Kathleen. Thanks to all of you for having me. I supported the decision this time because it represented continuity. You know, we have Janet Yellen was the Federal Reserve Chair. Her term concluded. We have a new chair in Jerome Powell. And I thought the decision this week represented continuity of what the Federal Reserve has been saying we're going to do. So in that sense, I supported the decision. And all of our colleagues are trying to balance our dual mandate of stable prices and maximum employment. Personally, I think we have a ways to go before we have achieved our dual mandate objectives. So one of the things that surprised us throughout the recovery is the unemployment rate has fallen from 10% now to 4.1%. We would have expected a lot of wage growth with that job market getting stronger. And we keep thinking we're coming close to maximum employment, and then all of these Americans come back into the job market, suggesting we were not really at maximum employment. And so for me, the thing that I'm really focused on is looking at wage growth. You know, we're trying to assess supply and demand in the labor market. And if you want to assess supply and demand in a market, start by looking at the price. And wage growth has not really accelerated very much. And so to me, that tells me that there's still some slack in the labor market. I want to see more wage growth. When I see more wage growth, I'll have more confidence that we are approaching our 2% inflation target, and then I'll be more supportive of rate increases.
But you did support
Well,
this
I was
decision.
not a voter.
I know, but Jay Powell said was it Humphrey Hawkins? He was asked about voters versus non-voters. Just to catch you up, not all of the 12 district bank presidents vote. They rotate that vote unless you're president of the New York Fed. But what he said was, I don't even pay attention to who's a voter. I listen to the influencers. I listen to the arguments. So what did you argue for? Did you support this decision?
I argued that if I had been sitting in the chairman's seat, I would have raised rates because we had told the markets we're going to raise rates. And for continuity's sake, I think it's important. But if I look at our dual mandate objectives and I look at the data, I don't think the data itself supports rate increases at this point in terms of achieving our dual mandate objectives. I personally would like to see more wage growth and have more confidence that we've actually used up slack in the labor market. Then I'll support more interest rate increases.
Okay, so let's look at dots. And again, summary of economic projections. The FOMC every 3 months updates their forecast for GDP growth, unemployment, and inflation. And based on that, they each individually say, I think this is how much we should hike rates this year, cut or not. Okay, and that's where we get this dot plot. The big debate or the big question was, with the Fed, the consensus was going into 2018, 3 rate hikes is what we need. But might they raise it to 4? We've had tax cuts and a lot of stimulus, right? Did you raise your dot?
I did bring some of my dots forward a little bit in light of the fact that there's a lot more fiscal stimulus now and there's a lot more spending now than we had realized there would be 6 months ago. So I brought some of my path a little bit further forward. The big open question is, what do all of these fiscal packages mean over the long term? And that at this point is totally unclear. Is it actually going to change the growth trajectory of the U.S. economy? Is it actually going to lead to more productive investment and a higher productive capacity? We just don't know. So we can model with some confidence the short-term stimulative effects. But does that lead to a long-term faster growth rate? We don't know.
So that's new, as you know, if you move your dots even forward. Do you have more than 2 hikes this year?
Well, I'm not going to get into my specific. The dots are anonymous for a reason, and I want to respect that.
Well, I think one of the things that puzzled people. Now, if you believe in the tax cuts, and they're going to boost spending, although maybe more for wealthier people, because as other Fed officials have pointed out, that's where they're heavily weighted. Some question about how much the corporate tax cut will stir business spending, because that depends on a lot of things,
sure,
including the cost of capital is just one. Meanwhile, we've got retail sales actually negative for the past 3 months. The Atlanta Federal Reserve Bank has this really cool thing. It's the GDP nowcast. They look at every number that comes in and they say, okay, what's GDP going to do this quarter? It started up close to 4% for the first quarter. It's down under 2% now. So in what could look like a pause or some loss of momentum in the economy, the Fed is moving ahead toward tighter policy. In fact, some people still want 4 rate hikes. It's a very narrow division between 3 and 4 now.
Well, again, we're always trying to balance. We get so much data. If you turn on Bloomberg TV or other channels, You're going to get so much data every day. And so we have to pay attention, look at this, but not overreact to short-term movements in the data. So the most important things that I focus on are our 12-month inflation measures. Are we actually getting back to our 2% inflation target? Looking at wage growth, looking at inflation expectations. I personally try not to overreact to short-term movements up and down in the data. The data moves around quite a bit. And so I agree. I mean, the data that you articulated for the last few months is what it is. But I think we're looking at the next year, the next 2 years, and then over the longer run.
Do you, Neel Kashkari, in the data, in all the information you get from people across your district, are you see signs that wages are really rising enough to make a big difference in inflation this year?
No. The most common conversation I have with firms, I've said this many times, is I ask them, I say, what's your biggest challenge? And they say, we can't find workers. And I say, okay, are you raising wages? And they say, no. And then I say, well, then you're just whining, right? You want more of something, but you're not willing to pay for it. That's called whining. And so until I hear businesses actually say, no, we're raising wages to attract workers, then I'm going to know that they're serious. And again, we're seeing, I don't want to, again, overreact to one jobs report, but a 300,000 number comes in the payroll report, the last one. We need about 100 or 120,000 jobs per month to keep up with population growth. So for the economy to create 200,000 jobs or 300,000 jobs, that means we're using up slack that was somewhere in the economy. That's remarkable, and that's happening at a time of modest wage growth. Imagine how workers are going to respond if wage growth picks up. I think we're going to see even more people get drawn into the job market. And so the most important determination we are trying to make, in my opinion, is how much slack is in the labor market. And I think the headline unemployment rate, which right now is 4.1%, that's historically been a pretty good proxy for slack in the labor market. I think that gauge is broken because of the financial crisis. And a lot of people have given up and are only now starting to re-enter the labor market.
I want to ask you about another big piece of news this week.
Sure.
And that was President Trump putting tariffs of up to $60 billion on Chinese exports. The Chinese, of course, are responding in kind. We saw a big sell-off in the U.S. stock market yesterday. We saw an Asian stock market sell-off overnight. Things are steadying today. But up until now, most Fed officials have sort of, I think, downplayed tariffs. If steel and aluminum, no big deal, smart part of the economy, won't have much impact. This is something, though, that raises a specter, and many people are saying these words now, quite seriously. Trade war? Can the Fed shrug off a trade war? What does it mean for the economic outlook?
No, of course not. I mean, if there was actually a full-fledged trade war between the U.S. and China, it would have a dramatically negative impact on the U.S. economy and on the global economy. And we couldn't shrug it off. And we'd have to look at what do we think it means for the outlook for inflation and the outlook for growth. So, I mean, I think I understand what the administration is trying to do, because I think for 20 years we have been in a conversation with China saying, hey, you should be responsible stakeholders. It's in your interest to be free traders. And I think we've learned that China is going to do whatever China is going to do. I mean, we can talk to them all we want, and they're going to do whatever they want to do. And so I think the administration is saying we want to show that we actually have some recourse. Now, the danger is it goes down a very bad path, and it leads to two major economies in a trade war. Obviously, we have to try to avoid that. But I also understand the desire to try to have a level playing field in terms of free trade around the world.
Were the effects of an actual trade war discussed at the FOMC meeting this week?
It was discussed in the context of and Chairman Powell talked about this in his press conference, in the context of downside. We're always looking at what are the upside scenarios for the U.S. economy that could surprise us, and what are the downside scenarios that could surprise us. 6 months ago, we were not talking about trade as a downside risk to the U.S. economy. Now trade is a downside risk, and I don't think we have a good sense of putting a probability on it, but it's something we have to pay attention to.
Is the biggest risk, inflation, because imports will cost more? Of course, the Fed might like that. Is the biggest risk less growth because it hurts our exports? Is the biggest risk financial instability? And I'm thinking of 2015 going into 2016, the Federal Reserve was thinking it was going to raise rates 3 times that year. First, we had a Chinese stock market sell-off, caused a lot of volatility in the U.S. and around the world. The Brexit vote in the summer. We're not anything like that now, but it seems to me that this is something that could impinge on the expected path. But in terms of where you're looking for something that would change the path, what is it?
Well, all of those things that you said, I think, are reasonable cases, and we'd have to look at it. I can't predict. My best guess is it would just be a shock to confidence. Confidence is actually enormously important to the U.S. economy, not just to the stock market, but to businesses making investment decisions. And if there was a trade war and a major shock to global confidence, then I think that you would see that manifest itself not only in equity prices, but also in bond spreads, et cetera, and the cost of financing for businesses would go up, and that would have an effect on economic growth.
You've already warned, and maybe you've changed your mind about this, but I believe as recently as December, you have said that Fed rate hikes, you were concerned they could actually help tip the economy into recession. So you already see that risk. Now we see this uncertainty and these other risks. Are the odds, is the risk of recession higher now than it was?
All of our metrics that we look at to try to forecast recession say the risk of recession in the next year or two is very low. But let me tell you, it's always low until it isn't. So don't take a whole lot of comfort from that. These indicators are not that helpful. I think there are risks. Look, the risks to the upside and downside. Right? We had a strong wage growth number in January that markets reacted to. If wage growth picks up, that's an upside to the economy. If there are trade imbalances or trade disruptions, that's a downside risk. I think the risks are probably about even right now.
Why does the U.S. dollar keep getting weaker? Now, we have had strength in the last 24 hours of this, risk on, risk off, risk aversion, where you go in with your money, right? Yen weakened, but then it popped back. Meanwhile, the trend has been Fed's hiking rates, signaling more rates, and dollar has been weakening. Why? What is the signal to the Fed?
We're not sure. I asked my economists. I've got a great team of economists at the Minneapolis Fed about predicting the dollar, and they say, ask us anything else, but trying to predict where currencies are go is probably the hardest job that they have. It could be moving around for a lot of different reasons. It could be that markets don't believe the rate path forecast that the Fed is putting out there, right? If you actually look at where Fed funds futures are, they are forecasting a shallower path than what the committee is transmitting in the summary of economic projections. And so, currencies end up moving not just based on what central banks do, but what they do relative to what people think they're going to do and how those expectations change. So trying to unravel that, I think, is quite complicated.
A weaker dollar pushes up oil prices. That helps the Fed reach its 2% inflation target, which they want to reach because they feel that will put some juice in the economy, right? Then firms can raise prices. We can get our paychecks a little bigger. At the same time, higher oil prices, higher gasoline prices, heating oil prices. He's from Minneapolis, after all. That hits your pocketbook. So how are you viewing that? Well,
we look at, all of these things move around, and we've got very sophisticated economic models where we say, and the board staff in Washington especially runs many different scenarios on, if this happens or that happens, what's the feedback loop to the U.S. economy? If something happens in Europe, we're not setting monetary policy for the benefit of Europe or for the benefit of Asia. We're setting U.S. monetary policy for the benefit of the United States of America and the citizens and Americans that we work for. But we also recognize that when we move monetary policy in the U.S., it'll have effects globally, which can then rebound back to the U.S. And we try to model that loop. And so we look at all of these things and try to just make the best assessment we can, given the fact that the data is imperfect, it often has a lag, and these things often work in conflict with one another.
One of my colleagues pointed out to me the obvious, but still, you hike the Fed funds rate above the rate of inflation this week, so we now have positive real rates for the first time in a decade. Is monetary policy tight now? Is it too tight? Is it just right?
Well, so there's a concept that we focus a lot of our attention on what we call the neutral interest rate, the neutral real interest rate. This is the interest rate that balances savings and investment in the economy. And we can't measure it directly. We can estimate where we think it is right now, and there are a range of estimates. It's probably very close to zero, neutral real interest rate right now. And this is being set for the last 30 years or so. It's been gradually declining. And this is being set by broader macroeconomic forces, such as demographic trends. The fact is, advanced economies are having fewer kids than they had in the past, and their populations are aging. It's being set by productivity and technology development. So we're trying to assess this all the time. My best guess is that monetary policy is probably pretty close to neutral right now. But there are a range of perspectives on this. I think some people would argue we're still somewhat accommodative. I think we're probably pretty close to neutral. And if we keep raising rates, we'll end up providing some tightening to the economy. But again, we don't know for sure. And that's what makes this challenging.